Let's get more insight on the performance of China's banks with Dan McClory. He's the managing director at Burnham Securities. Dan, good to see you. Thanks for joining us.
It's always great to be on the show, Michelle.
Dan, China's biggest banks posting their lowest annual profit growth in a decade. What is the reason for the big decline? Is this mostly due to bad loans?
Mostly due to bad loans, I think, is correct. You know, there's about 200 billion in bad loans and write-downs that have occurred at the big four Chinese banks. But it's also due to the lifting of the cap on what can be paid out for depositors. So that occurred, as well as interest rate reductions. We're up to 6 of them in a row now. So you've basically got a compression of the net margin, which has resulted in a lot less profitability. In effect, you have a greater demand for borrowing because borrowing costs have been reduced, but the banks are less able to make a large spread because they're paying out greater rates on deposits.
All right, so tighter margins, but let's focus a little bit more on these bad loans. The 3 top banks, their results showed that they wrote off the equivalent of about $22 billion in irrecoverable debt last year. So this is indicating that customers, many of them state-owned industrial companies, are not able to pay back their loans. Dan, why are so many of these companies not able to pay back?
Well, the fundamental problem, Michelle, is China has become the overcapacity capital of the world. It actually has, and there are a lot of inefficient industries. Premier Lee has talked about taking out the long knives and cutting through some of these zombie enterprises. But the challenge right now that is being faced, because there's discussions about exchanging non-performing loans and debt for equity positions in these companies, is you're running the risk of perhaps creating some zombie banks. So that has to be done with great care and great prudence, any adjustments. But it's inherently, there's some inefficiency in the system that has to shift, and that has to be transitioned out of the economy.
Let's talk a little bit about this debt for equity swaps that the People's Bank of China is now advocating to lower the leverage in corporate companies. What are the risks here? Is this a good idea?
Well, of course, what no one would want to see is to have bad loans turn into bad equity. Okay, so this is meant to be a way to deleverage companies, but it only works if those companies are fundamentally sound. And this is where the problem lies. There's been a misallocation of capital that has gone to less productive and industries with great overcapacity, and the industries that are perhaps greater drivers of growth have been denied opportunities for capital. So this can only work if there is a fundamental shift in getting capital from the people who have it to the people who need it. And this can be addressed in a number of ways.
Dan, look, we both know that the banks do have enough reserves to cover these losses. This is not anywhere near a crisis yet. But can they keep up if more and more of these loans do continue to go sour? And is that the trend that you see continuing as the economy continues to slow down in its growth?
I think the banks are ultimately going to be able to keep up. I mean, we know that the big four Chinese banks are implicitly backed by the government. And so you could say, on the one hand, there's great concentration of risk in the hands of those 4 institutions. But on the other hand, they are way too big to fail. So I think what needs to take place is a diversification of the sources of capital, both debt and equity. Of course, the stock market would be a great place to start. Most developed economies have a far greater reliance on the stock market than has been the case in China. The stock market, for example, last year only accounted for about 5% of capital that went into operating companies, whereas the banks accounted for about 70% of that capital. So we've got to reallocate and realign and take some of the stress off of the banks to be the sole providers of that capital. Corporate bonds are another way of bringing in outside capital and non-bank capital to finance companies. But we really need to see this shift taking place and get this capital reallocated.
You know, to your point, Dan, that a lot of pressure has been put on the banks. The government has cut interest rates 6 times, lowered the reserve ratio requirements, and also trying to boost the housing market by reducing the minimum deposit required. What has been the impact of all of these moves on the banks?
Well, I think the moves to attempt to increase lending in the real estate sector, residential real estate, are probably not going to have much of an effect. We know that in China, leverage in residential home purchases is far less prevalent than it is in the U.S. But I think one of the effects that has taken place, is China has a prolific amount of savings. I don't know if you're aware of this, but in 2015, Chinese savers put away about $5.2 trillion, and the U.S. savers put away about $3.4 trillion. So there's a lot of capital that's available, and of course, China wants to be prudent with capital outflows and the ability to diversify one's portfolio. But I think a lack of capital going into the residential real estate and housing sector has led to an accumulation of savings, and banks should try to find a way to tap into that with some innovative products.